Let me ask you something that most gold owners never think to ask, and the answer might genuinely shock you. Where exactly is your gold right now? Not in the general sense, not it's in a vault somewhere, but specifically, do you know which vault, in which country, under whose legal name, and under what kind of storage agreement? Because what I'm going to walk you through today is one of the most overlooked risks in the entire precious metals world. A risk that has already destroyed the savings of thousands of investors who thought they owned gold, but discovered at the worst possible moment that they actually owned something very different. Gold right now is trading above $4,000 an ounce. Think about what that means for a moment. Every single troy ounce of physical gold you own, or think you own, represents serious wealth. Not speculative wealth, not paper wealth, real, tangible, thousands of dollars per ounce wealth. And yet, millions of Americans who've accumulated gold, whether through a dealer, through a gold IRA custodian, through an ETF, or through a bank storage program, have never once picked up the phone and asked the one question that could determine whether they actually own any gold at all. The question is this: is my gold allocated or unallocated? If you don't know what that means, stay with me, because by the time we're done today, you're going to understand the gold market at a level that most financial advisors have never bothered to explain to their clients. You're going to understand exactly why this matters so much right now, with gold near record highs, inflation stubbornly elevated, geopolitical tensions reshaping the world order, and a financial system under more stress than any time in recent memory. And you're going to know exactly what to do about it. Let's start at the very beginning, because this story has deep roots. When you buy a gold bar from a reputable dealer, you get a physical object. It has weight, a serial number stamped into its surface, a hallmark from the refinery that produced it, maybe Pamp Suisse, maybe the Perth Mint, maybe Valcambi. It's yours. You can hold it, feel its weight, lock it in your safe. Nobody else has a claim on that bar. Nobody can lend it out, pledge it as collateral, or use it to paper over their own financial problems. That's what most people picture when they think about owning gold. And if your gold is sitting in your own safe at home or in a properly structured, segregated private vault, that picture is accurate. But here's where it gets complicated, and this is where the problem begins for a very large number of gold owners. A lot of gold that people think they own isn't actually stored that way. When you buy gold through certain dealers, certain bank programs, certain ETFs, or even certain gold IRAs, you aren't necessarily buying the right to a specific bar with a specific serial number sitting in a specific vault with your name on it. Instead, you're buying what's called an unallocated account. And an unallocated gold account is, in the most fundamental legal sense, not gold ownership at all. It's a debt. Let me say that again so it really lands. An unallocated gold account means you are an unsecured creditor to the institution holding the gold. You don't own gold. You own a promise to pay you gold. And as we have learned painfully over and over throughout financial history, promises made by financial institutions can evaporate overnight when those institutions run into trouble. The London Bullion Market Association, the LBMA, is the world's largest gold trading hub. Trillions of dollars worth of gold changes hands through London every single year. But here's what the financial press rarely discusses openly. The overwhelming majority of that trading is in unallocated paper gold. There are serious analysts and market observers who have studied the LBMA's trade data for decades and estimated that for every single ounce of physical gold that changes hands, there may be dozens, possibly hundreds, of paper claims for gold that are traded alongside it. The system works fine as long as everyone doesn't try to take delivery at the same time. The moment a genuine panic sets in, a genuine rush for the physical metal, that entire structure becomes extraordinarily fragile. And before you think this is some fringe conspiracy theory, let me walk you through what has actually happened in the real world. Cast your mind back to the autumn of 2011. A firm called MF Global, one of the largest futures brokers in the United States, collapsed in spectacular fashion. What emerged from the wreckage left precious metals investors in absolute shock. Customers who held gold and silver in what they believed were segregated, allocated accounts discovered that their metals had been commingled with company assets and used as collateral for the firm's speculative trades. When MF Global went bankrupt, those customers were not treated as the owners of gold. They were treated as unsecured creditors. They stood in line with everyone else, waiting to recover pennies on the dollar of what they had trusted this institution to protect. People who had specifically chosen physical metals precisely to get outside the financial system found themselves trapped inside its worst failure modes. Before that, in 2008, when Lehman Brothers collapsed and the financial system nearly disintegrated entirely, gold derivatives and paper gold products became enormously complex to unwind. Investors holding gold through financial products discovered that the counterparty chains they were exposed to were longer and more treacherous than anyone had ever been told. The very institutions that were supposed to be safeguarding wealth were the ones creating systemic risk. Go back further to 1971. This is one of the most important events in modern monetary history, and its echoes are still shaping the gold market today. When President Nixon closed the gold window, he essentially told the world that the United States government would no longer honor its promise to exchange dollars for gold at any fixed rate. That promise had been the backbone of the Bretton Woods system, the foundation of the post-war global financial order. Overnight, paper promises that had been treated as equivalent to gold were revealed as exactly what they were: pieces of paper. The lesson burned into the consciousness of every central banker, economist, and serious monetary thinker was simple. When the pressure is high enough, paper claims on gold are not the same as gold. Fast forward to this decade, and we are watching something extraordinary happen that most mainstream media has barely covered. Central banks around the world are buying physical gold at some of the fastest rates ever recorded. These aren't mom-and-pop investors. These are the institutions that understand the global financial system from the inside. The Bank of China, the National Bank of Poland, the Reserve Bank of India, the central banks of Turkey, Hungary, and a growing list of others have all been aggressively accumulating physical, deliverable gold. Not paper gold, not ETF gold, physical bars, repatriated to their own vaults under their own sovereign control. Poland alone repatriated over 100 tons of gold from the Bank of England. Germany spent several years methodically repatriating hundreds of tons of its gold stored in New York and London. Why would Germany spend the time and diplomatic capital required to physically move all that gold? The official explanation was straightforward enough. They wanted it closer to home. But the deeper reason, understood by anyone who watches this space carefully, is that Germany wanted to make absolutely certain that what they were promised actually existed and was actually theirs. Because in the world of large institutional gold storage, even nation-states have sometimes had to confront the uncomfortable question of whether the gold they were promised was really there. And that's the question that individual gold owners in America need to be asking right now, with gold at these historic levels. Here's how the mechanics actually work. When a financial institution offers you gold storage, whether it's a bank, a bullion dealer, or a digital gold platform, they typically offer you a choice between two types of accounts, though they don't always make the distinction crystal clear. In an allocated account, specific bars with specific serial numbers are registered in your name. The custodian physically separates your bars from all other assets. Your gold is not on the custodian's balance sheet. If that custodian goes bankrupt tomorrow morning, your gold is not part of the bankruptcy estate. It's yours, and you walk in and take it out. In an unallocated account, the institution holds a pool of gold on behalf of all its clients, and you own a claim against that pool. Your gold is on the custodian's balance sheet. If they go bankrupt, you are an unsecured creditor, and we've already discussed how that plays out. Now, there's another layer to this that goes even deeper and is even less discussed: the concept of rehypothecation. This is the practice by which financial institutions take assets that have been pledged as collateral and pledge them again as their own collateral. In theory, it's a practice that creates liquidity in the financial system. In practice, it means that the same physical gold bar can have multiple claims against it simultaneously, stacked in layers that are almost impossible to untangle until something goes wrong. The gold lending market operates on a principle that would raise eyebrows if most ordinary investors understood it. Central banks have historically lent gold to commercial banks, which have lent that gold to mining companies or other financial players. The same ounce of gold has obligations running through multiple institutions across multiple jurisdictions. As long as nothing breaks, as long as none of the counterparties in this chain experience financial stress, the music plays on. But in a genuine financial crisis, when everyone rushes for the physical metal at the same time, this entire paper architecture begins to buckle. Before we go further, I just want to flag something quickly. If you're watching this and you've been concerned about your retirement savings, how to protect your wealth from inflation and from all these risks we're talking about, I put together a free guide in the description below that covers some of the saving secrets thousands of American retirees are using right now to protect their hard-earned wealth. Just check the description and grab it. It's free. Now, let's keep going because this gets even more important. So, what does all of this mean for you, practically speaking, as someone who either owns gold or is thinking about protecting your wealth with gold? The first thing you need to do is find out exactly what kind of account you have. If your gold is stored through any third party, a dealer storage program, a bank vault program, an ETF, any institutional arrangement, you need to get on the phone today and ask 3 specific questions. Is my gold allocated or unallocated? Can you provide me with a list of the specific bar serial numbers that are assigned to my account? And is my gold subject to any lending, leasing, or encumbrance arrangements? If you can't get a straight, documented answer to all 3 of those questions, you have a problem. If your gold is held in an ETF, and there are hundreds of billions of dollars worth of gold ETF assets held by American investors, you need to understand that the structure of most gold ETFs creates exactly the kind of counterparty risk we've been discussing. The largest gold ETF in the world holds its gold through a custodian, and that custodian is permitted under the fund's own prospectus to use sub-custodians. Those sub-custodians may use further sub-custodians. By the time you trace the chain from your brokerage account to the actual physical bar, you have passed through multiple layers of legal exposure. In a normal market environment, this doesn't matter. In a financial crisis, these chains matter enormously. Now, let's talk about what actually constitutes safe gold storage and why the question of location matters even beyond the allocated versus unallocated distinction. Location matters for several reasons that are rarely discussed. The first is jurisdictional risk. If your gold is stored in a country with a history of capital controls, currency crises, or government seizure, the legal protections around your ownership are only as strong as that country's rule of law in a crisis. Switzerland has a centuries-old tradition of property rights and financial neutrality. Singapore has emerged as one of the most respected bullion storage jurisdictions in Asia. The Cayman Islands and New Zealand offer strong legal protections as well. Bank vaults in countries with weaker institutional frameworks offer weaker protection, and that includes, for certain scenarios, even domestic bank vaults in the United States. The second location consideration is accessibility. In a genuine crisis, can you physically retrieve your gold within a reasonable time frame? If your gold is in a vault on another continent, it may technically be yours under law, but your practical ability to access it during a crisis is limited. The ideal storage arrangement balances jurisdictional security with practical accessibility. The third consideration is insurance. A properly structured allocated storage account should come with comprehensive insurance covering theft, loss, and institutional failure. You should be able to obtain documentation of that insurance coverage, the name of the insurer, the policy limits, what is and isn't covered. If your storage provider cannot furnish this documentation, that's a serious warning sign. Let me tell you a story that illustrates exactly why all of this matters. In the years following the 2008 financial crisis, a lot of institutional investors who had been sitting on what they thought were comfortable gold positions discovered something unsettling when they went to verify their holdings. Some of them found discrepancies. Gold that was listed in their accounts had been lent out, rehypothecated, or simply wasn't there in the form they expected. Audits of custodial holdings revealed that the paperwork and the physical reality didn't always match, not because of outright fraud in every case, but because the system itself was structured in a way that allowed the same metal to serve multiple masters simultaneously. This is not a new problem. It goes back to the very origins of paper money. The first banks in medieval Europe were goldsmiths who held physical gold for their depositors and issued paper receipts for that gold. Those paper receipts became the world's first banknotes. And very quickly, the goldsmiths noticed something. Their depositors rarely all came in to retrieve their gold at the same time. So they began doing what every banker has done ever since. They issued more paper receipts than they had gold to back them. When times were good, nobody noticed. When panic spread and depositors rushed the doors all at once, the system collapsed. The names change, the mechanisms evolve, but the fundamental dynamic, more paper claims than physical metal, has remained a feature of the financial system for centuries. And here's why this particular moment in history matters so much more than it might have a few years ago. The macro backdrop has shifted profoundly. Inflation, after years of being dismissed as transitory, has proven to be a much more durable and structural force than most mainstream economists admitted. The Federal Reserve has gone through one of the most aggressive rate environments in modern history and is now navigating a delicate balance between fighting inflation and not triggering a recession. The national debt of the United States has reached levels that would have seemed unimaginable just a decade ago, and the interest payments on that debt are consuming an ever larger share of the federal budget. De-dollarization, the movement by countries like Russia, China, India, and others to reduce their dependence on the US dollar in international trade, is no longer a fringe theory. It's happening in real time as these countries build alternative payment systems, bilateral currency arrangements, and gold-backed reserves. The BRICS nations have been actively exploring gold's role in a new international monetary architecture. When countries that collectively represent a majority of the world's population and a substantial portion of its economic output are looking to gold as a foundation for a new financial order, that is a profound signal about where we are in the cycle of monetary history. The last time the world reconfigured its monetary architecture, in 1971, gold went from a fixed price to a freely floating price and multiplied in value many times over in the years that followed. The current reconfiguration is happening more slowly, more gradually, but the directional logic is the same. Central banks are not buying gold because they think it's a good trade. Central banks are buying gold because they understand, better than most, that the global financial system is under structural stress that will eventually require resolution. And when financial systems are resolved, when currencies are reset, when debt is restructured, when the rules of the monetary game are rewritten, the entities holding physical gold come out ahead. Every single time. That's been the lesson of every monetary crisis, from ancient Rome to Weimar Germany to modern Venezuela. Here's what I want you to really internalize as we get into the specifics of what to do. The danger isn't that gold will fail you. Gold has never failed anyone who actually held it. The danger is that you might think you hold it when you actually hold something else. A paper receipt, a digital ledger entry, a promise from a financial institution. And in the kind of environment we are moving into, with geopolitical realignment, with inflationary pressures, with sovereign debt at unprecedented levels, with the dollar's reserve currency status under genuine long-term challenge for the first time in half a century, the gap between physical gold and paper promises to gold could become the most important financial distinction of this era. Now, here's the practical framework. If you hold physical gold at home, in your own safe, your risk profile is very different from someone who holds gold through third-party storage. You have no counterparty risk. You have no rehypothecation risk. Your main risks are physical: theft, fire, natural disaster. These are manageable risks that can be addressed with a good safe, proper insurance, and smart security practices. If you hold gold in a private vault, outside the banking system, meaning an independent, non-bank vault company with an allocated, segregated account structure, your risk profile is also relatively strong, provided the vault is reputable, properly insured, and subject to regular independent audit. The problematic structures, the ones where you need to take immediate action if this is your situation, are the following. Unallocated accounts with dealers or banks, where you own a share of a pool rather than specific identified bars. Gold ETFs, where multiple layers of custodial arrangements create exposure that most holders have never read through carefully. Digital gold platforms, some of which have excellent structures, and some of which are essentially running a fractional reserve operation against their clients' deposits. And certain gold IRA structures, where the custodian's actual storage arrangement with their vault partner hasn't been properly scrutinized. Now, speaking of gold IRAs, and I want to bring this up because it's directly relevant to a lot of people watching this. If you're sitting on retirement savings that are currently in a traditional IRA, a 401k, or some other tax-advantaged account, you have an option that a lot of people don't know about. A gold IRA allows you to hold physical IRS-approved gold within a tax-advantaged retirement structure. The gold has to be stored with an approved custodian, but the key, and this is the key that most people miss, is that a properly structured gold IRA holds specifically allocated, segregated physical gold bars or coins in your name. You're not holding paper gold. You're not holding an ETF. You're holding real metal. And that metal sits as a direct counterweight to all the paper risks we've been discussing: the market volatility, the currency debasement, the geopolitical uncertainty, the debt levels that will eventually have to be reckoned with. If protecting a portion of your retirement savings from these very real systemic risks is something you've been thinking about, this is absolutely worth understanding properly. There's a link in the description where you can learn more. Let me walk you through exactly what to do if you decide, after watching this, that you want to verify and potentially restructure your gold storage. Step 1. Documentation audit. Pull out every piece of paper, every account statement, every contract related to your gold holdings. Look for the specific language around storage type. Words like segregated, allocated, identify bars, and specific serial numbers are what you want to see. Words like pool, unallocated, commingled, or language describing you as a creditor rather than an owner are warning signs. Step 2. Custodian interrogation. Contact every institution that holds gold on your behalf and ask explicitly, is my gold held in an allocated, segregated account? Can you provide documentation of the specific bars, including serial numbers, weight, and refinery hallmark, assigned to my account? Is any of my gold subject to lending or leasing arrangements? What insurance coverage applies to my holdings, and what are the policy details? Step 3. Independent verification. For any significant holding, consider whether the custodian will permit an independent audit or, at minimum, provide you with vault inspection rights. Reputable custodians, particularly those catering to institutional clients, typically offer this. A custodian that resists independent verification of your holdings is a custodian you should think hard about. Step 4. Diversification of storage. Even if your primary storage arrangement is sound, consider whether you are overly concentrated in one location, one jurisdiction, or one custodian. Gold's entire value proposition as a wealth preservation asset is tied to its resilience in crisis scenarios. That resilience is undermined if all your gold is concentrated in a single institution that could itself be a casualty of the very crisis you're trying to protect yourself from. Step 5. Rebalancing toward physical possession for at least a portion of your holdings. Not all of it. There are practical limits to how much gold you can securely and safely store at home. But having some physical gold that you can access immediately, without any intermediary, without any counterparty, is a fundamentally different kind of security than having gold held by a third party, however reputable. Consider what we know about how financial crises actually unfold. They don't announce themselves in advance. They don't give you 2 weeks' notice to move your assets. They happen on a Friday afternoon when markets close, and by Monday morning, the rules have changed. They happen when governments announce banking holidays, capital controls, or emergency measures. They happen when an institution that everyone believed was rock solid reveals that its balance sheet is a work of fiction. In those moments, and history tells us these moments come, even if we can't predict exactly when, the people who are holding physical gold in their own hands or in a properly structured allocated account they can access quickly are in a very different position from the people who are holding claims, promises, and paper receipts. The Germany story I mentioned earlier deserves a moment of deeper reflection. Germany is arguably the most financially conservative, inflation-conscious major economy in the world. The German relationship with sound money was forged in the crucible of not one, but 2 catastrophic hyperinflationary episodes in the 20th century. Germans understand in their national DNA what happens when paper money loses its anchor to something real. And even Germany, even a country with all the diplomatic relationships, legal resources, and institutional credibility of a major European power, found it necessary to physically repatriate its own gold from foreign vaults because it wanted to verify with absolute certainty that what was promised was actually there. If Germany felt the need to ask that question, so should you. There is an enormous amount of complexity in the gold market that is deliberately obscured from ordinary investors. The language is confusing, the legal structures are opaque, the custodial arrangements run through multiple layers of intermediaries. This complexity serves the financial industry because it keeps investors at arm's length from the simple truth. In a genuine crisis, only physical gold that you control is truly, safely, unambiguously yours. We are living in a moment of extraordinary monetary history. Gold at these levels is not just a commodity price movement. It is a signal being sent loudly and clearly by central banks, by institutional investors, by sovereign wealth funds, and by millions of ordinary people who have looked at the trajectory of government debt, the reliability of paper currencies, the fragility of financial institutions, and the turbulence of geopolitical realignment, and decided they want something real, something no government can print. something no financial institution can rehypothecate into vapor, something that has functioned as the ultimate store of value for 5,000 years and has survived every empire, every currency collapse, every financial panic, and every attempt to replace it with something else. Gold has outlasted Rome. It outlasted the British Empire's sterling standard. It outlasted Bretton Woods. It will outlast whatever is coming next, but only for the people who actually own it, not just the paper promise of it. The urgency in the title of this video is real. We are not in a normal market environment. We are in a period of accelerating change, monetary, geopolitical, and financial, where the questions that seemed academic in calmer times have become intensely practical. Where is your gold? What exactly do you own? Who has custody of it, and under what legal terms? Does the paper match the physical reality? These are not abstract questions. They are the questions that determine whether, in the moment when gold's protection matters most, you're actually protected.